My name is Michael Guy, publisher of the Lead Lag Report. Join me for the hour is Mr. Ron Insana. I know a lot of people have seen over the years doing the media runs, but Ron, for those who are not familiar with who you are, introduce yourself. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Yeah, a couple things. So I started my career rather accidentally at the Financial News Network. I was a film major in college at California State University, Northridge in Southern California, and couldn't get a job in entertainment. So a friend of mine from high school got me an entry-level position at Financial News Network. That turned into a 39-year gig, if you will, in one form or another. I was a anchor for 22 of the 23 years that I was at FNN and CNBC, and a contributor ever since 2006. I've run a multi-strat hedge fund of funds. I've been a senior advisor to Schroders. I'm currently the chief market strategist at Dynasty Financial, which is a platform for independent investment advisors. And, continue to speak around the country. I'm still a contributor at CNBC. So coming up on 40 years next June of being involved one way or another, either as a financial journalist or a participant in the markets. And, it's been an extraordinary run, and I've learned a great deal from many people, some of whom you know, and have been tutored by some of the best. So, I've also been through 40 years worth of market cycles. And so when you start talking about a credit event upcoming, I certainly don't disagree. The question is, where's it going to come from? And what's the magnitude of the event once it takes place?
So the term market cycles is important to focus on. No two cycles are exactly alike, but there are parallels. History does tend to rhyme. When you think about where we are in this cycle, how do you think about any historical comparisons, not just in terms of market cycles, but business cycles? Because the two are often, I'd argue, quite different.
Yeah, I wouldn't disagree with that. And this is one of the first, I think, periods in my experience where I've not been able to make a uniform statement about the economy. Having said that, from a gross domestic product standpoint and from an inflation standpoint, the U.S. is growing faster with less inflation than the rest of the G7 industrialized nations. We're growing faster than China, possibly and quite possibly with fewer problems than China currently has. Talk about a credit event. They have a property sector which accounts for 30% of their GDP that is literally imploding, before our eyes. It's interesting. There are very strong spots within this economy. There are weak spots, and then there are trouble spots that are asynchronous and somewhat in a weird way unrelated. Like existing single family homes and the sales of them are depressed because over 90% of existing single family homeowners have mortgages below 6%, 80+% below 5%, 60+% below 4%, 23% below 2%. We have a post-COVID lockdown for existing single family homeowners who can't sell. On the flip side, we have problems in commercial real estate, rather large problems in commercial real estate. $1.2 trillion of that debt needs to be refinanced next year at considerably higher rates, $270 billion of which is on the balance sheets of small and medium-sized banks. So we have these, as you keep identifying credit events, we have these pockets of potential trouble down the road. At the same time, while manufacturing is in recession and has been for quite some time, manufacturing capacity is being built out faster than any other time in recent memory, where $500 billion is being sunk into the ground thanks to the CHIPS and Science Act and the Inflation Reduction Act, however poorly named it was. Consumer is still reasonably strong, still spending money. The Atlanta Federal Reserve is estimating the third quarter GDP is growing at 5.1%. A lot of that's from fixed investment. The trade deficit has flipped because we're getting fewer imports from China. Net exports are a positive to GDP, and so is government spending. So it's a tough economy to characterize. Again, it's uneven. It's fractured in ways I've not seen it before, but we're still growing reasonably fast. And you can discount that Atlanta Fed GDP number by about 2 percentage points. And we're still growing around 3% with inflation coming down. So, I like the U.S. compared to the rest of the world. It's 2024 that I'm worried about.
So actually use the exact term that I myself believe best characterizes everything that's going on, which is asynchronous, right? You said it correctly. It's hard to make a uniform statement about the economy. It's also hard to make a uniform statement about asset markets, right? I myself have continuously argued we're still in a bear market, which sounds weird. But if you look at small caps, retailers, Europe, emerging markets, most things outside of the mega cap, market cap, NASDAQ, and S&P, any 5-year-old technician would say those are bear markets. You're not anywhere near the prior highs, let alone after inflation adjusted highs. So you do have this not just asynchronous behavior in terms of different pockets of the economy and almost selective credit event problem areas on a micro scale, but even when you look at the investable landscape, things are not co-moving the way you would expect.
Right. And depending on how you were trained in our business, a bull market is when you take out the old highs and then proceed to go to a succession of new all-time highs, something we have yet to do, as you rightly point out. Are we more than 20% off the lows that we saw during the bear market cycle? Yes. Are there stocks that have done considerably better than that over that period of time? Absolutely. The Magnificent Seven, come to mind. But, look, when you look at the S&P X, the Magnificent Seven, the big cap technology stocks that have gotten an AI boost, those stocks are effectively flat on the year. The Russell 2000, which was up 12% just a couple months ago, is basically now flat on the year. Bonds continue in a bear market. Oil's in something of a bull market, but I think people may be overstating its importance, and we can talk about that later with respect to how it affects the economy today versus the 1970s. And, certainly the biggest bear market is in bonds. The TLT is down 55%, which represents the 10-year Treasury note in an ETF format. And that's as big a decline as we had in equities during the 2007 to 2009 bear market for stocks. So, yeah, it's asynchronous in a lot of ways. I don't spend a lot of time looking at overseas markets. I do keep an eye on them. I think that, for domestic investors trying to play those markets, particularly when the dollar's appreciating rather than depreciating, becomes a difficult proposition. So, we've seen decent gains. They haven't really outpaced the US in a meaningful way, unless you're investing in Turkey, South Korea, Japan, or Argentina, which is up well over 100%, but so is their inflation rate. So who cares? At the end of the day, your inflation adjusted returns. And then when you adjust for currency in the US, you're probably losing money on that trade. So, to me, I don't know that we're in a bull market in the US. I tend to agree with you that, this is still a bear market bounce until proven otherwise. It's been a strong one. And, for people who have been overly bearish and who have kind of missed the move, they've probably given up some gains either in the S&P or in the NASDAQ 100, the Qs, whatever. But you're also able to pull 5.5% from a one-year Treasury note, which is not the worst thing in the world if that's what you've done in the interim.
Is there anything about this environment that reminds you a little bit about the late 1999 into early 2000 period, the concentration of momentum, the kind of mania and narratives around AI? It's not, again, not exactly a parallel, but I think there's some dynamics that are similar.
Really small. If you go back, if you in my world, if you rewind the videotape or pop in a CD or do whatever the appropriate analog is at this point, roll back the MP4. Remember that in 1999, 1,000 internet companies went public, 77% of which were unprofitable, and some subset of that had no revenues and largely took in investor dollars to advertise products that had yet to be created. And the speculative frenzy was such that retail was very deeply involved in the internet mania from 95 well into the year 2000, and then the crash came. If we're in an AI bubble, it's in its infancy because we haven't seen the issuance of companies that are in the AI space, in the hundreds or in the thousands of companies over a period of time. It's not cocktail party conversation when you go out and about, where everyone on the street is asking you, about which AI stock you should buy. The gains have been concentrated in those 7 stocks that we've already talked about. And so while they are very richly valued, remember that, I think the NASDAQ's price earnings ratio in 1999 was close to 100 for the entire index. And there were companies that had infinitely high PEs that were immeasurable because they had neither revenues nor profits. And so I think it's a slightly different environment. We may get there at some juncture. To me, this is more like the Nifty 50, if you will, of the early 1970s, where a handful of stocks carried the market because they were involved in technologies that were going to propel us forward, whether it was Federal Express or Xerox or Polaroid or a host of other companies that were kind of, at that time, involved in cutting edge technologies. So I think that's maybe a more appropriate analog than 1999 because you just don't have the full scale popular mania for these things that we saw in 99. I mean, listen, there's this anecdote that I put in a book of mine way back when. There was a gentleman on the floor of the New York Stock Exchange, specialist by the name of Peter Henderson, who on December 23rd, 1999, was being interviewed by me during my show Street Signs, which was on from 3 to 4 every day at that period. And he stopped me in the middle of our conversation. He said, look, I was walking into the exchange today and a homeless individual, stopped me and asked me for some money, which he gave him. And then subsequently asked him whether or not he worked at the exchange. And he said he did. And then asked him about internet stock. So not to condescend to anyone who was in that position, but when a homeless person is asking you which internet stock to buy, the last marginal buyer has come into that mania. And I don't think we're there quite yet.
So you mentioned next year is what worries you. Next year is not that far away.
No,
right?
absolutely not.
So let's get into that. What is it about next year that worries you?
Well, I think, to your point, and I've been following you, as you well know, talking about credit events, whether it's China, and it's hard to know whether China has a contagion effect because not a lot of domestic companies have exposure to Chinese real estate, which is imploding as we speak. But you do have this, overhang of over $1 trillion worth of commercial real estate debt that needs to be refinanced next year. And it was obviously financed at considerably lower interest rates than where we'll be next year. And that is a problem. And it's going to be a problem. And it's going to be a problem for select banks. I mean, it looks to me more like the S&L crisis of the late 80s and early 90s than it looks to me like 2008. But it's still a large scale problem. And it's one, in my mind anyway, it's one of the things that can cause the Federal Reserve not just to continue its pause, but to pivot and start lowering interest rates. Similarly, the other credit issue that's out there is the, rather sizable U.S. debt, the running of deficits, which today the interest burden on the government is considerably higher since the Fed raised rates so far so fast. And while I don't expect the Fed necessarily to monetize that debt, any relief on the interest rate front, given that the average maturity of U.S. Treasuries that are held is about 4 years, they're going to ultimately have to do something to ease the interest burden on the Treasury in the absence of any structural reforms in government spending and revenues and so on and so forth. So I think there are two things where we may hit a wall next year that can make it difficult for the Fed to maintain this higher for longer posture. And then third, the National Association of Home Builders is begging the Federal Reserve to stop raising rates and possibly cut them because the statistics I mentioned previously, where most homeowners have mortgages that average around 4%, you've got this post-COVID lockdown where people can't sell their houses. And even if they were to downsize, it would probably cost them more, or at least the same, to go into a smaller house at a much higher mortgage rate. So I think there's kind of a triple whammy out there. And again, with China in the background, that's going to ultimately, I think more than most people expect, force the Fed to turn around and start cutting rates sometime at the end of the first quarter, beginning the second quarter next year.
And also, I think you can argue it gives them some saving face, right? Under the idea that, they have to do due to forces outside of their control, as opposed to maybe the reality that they probably already over tightened.
Yeah, that has been my position for quite some time. I never thought they needed to go 5.5, 5 3/4. I thought they should have stopped at 4%. Look, when you break down the inflation data, and people get very picky and kind of really nasty about where inflation currently sits. When you look at the inflation measure most closely watched by the Federal Reserve, which is the core PCE, that's included in the personal income and spending data, the personal consumption expenditure deflator, my favorite phrase in the world, over the last 3 months is running at a 2.1% annual rate. And because shelter costs are elevated thanks to higher mortgage rates, you're getting kind of a false read on inflation. If the supply of homes was unlocked and people were able to move, prices would become much more malleable, mortgage rates would come down, and there would be less pressure on inflation. So I think inflation's coming down a lot more than people realize. It's certainly come down a lot from where it was. And the Fed is overly restrictive right now. And as you and I both know, that's the environment that triggers an event. Whether, back in March, it was the mark-to-market losses on the balance sheets of Silicon Valley Bank, Signature Bank, and others. We have mark-to-market losses on bank balance sheets right now because they're holding treasuries that, again, are underwater from a principal perspective. So there's going to be an event, and the Fed's going to break something, and they're going to have to turn around.
I don't know why the over-tightening argument has been getting so much pushback by economists. Look, pre-election year tend to be the strongest of the presidential cycle.
Yep.
Right? We're in pre-election year, and yet small caps have done nothing.
Nothing.
So that's got to tell you that they over-tighten. You think that, interest rates would most affect small cap companies because they're more domestic, regional consumer. if the fact that they've done so poorly on a relative basis when the cycle should unequivocally favor them is I think a really strong signal that the Fed really is wrong.
Yeah, and look, I mean, I think, and you have folks like Larry Summers who have been really leaning on the Fed to do more, to tighten more, to make sure that we don't go into a 1970s style wage price spiral, which I think already has been disproven. Wages are rising now faster than inflation. And again, barring a massive regional conflagration in the Middle East that draws in Iran, Russia, China, the United States, and oil goes to $180 a barrel, which would be the fundamental equivalent of what it did in 1973. And that stokes inflation and creates all sorts of other problems in the economy. Absent that, the Fed's done too much. And when also, as I look at the situation, and a lot of people like Larry Summers and my friend Jason Furman like to compare this to the 70s, you had a series of shocks in the 70s that actually started in the 60s, which was escalating spending for both the Vietnam War and social programs simultaneously. One could argue we did something similar in the pandemic, but it's not the same. And then you had the U.S. going off the gold standard in 71, the Arab oil embargo in 73, policy mistakes in the mid-1970s, the Iranian Revolution in 79, at a time when, and I just looked this up this morning actually, the average miles per gallon for a U.S. car in 1973 was 11.9 miles per gallon. Today it's 32. And 5.6% of the U.S. car fleet is electric. So the energy intensity of the economy is radically different. And again, to do the equivalent of what happened in 1973 to gasoline and oil prices, you'd need oil at $180 a barrel. And as much as oil has rallied to $86 today on the intensification of the violence and the war between Israel and Hamas, we're down from 93 a couple of weeks ago. So we're not making new highs in oil. So I think the Fed's just really misreading this. And guys like Larry Summers, who is the smartest guy in the room, and he will be the first person to tell you that, keeps pounding this nail that we need tighter credit conditions, which are already plenty tight. And we need a higher unemployment rate to drive down inflation. And I just fundamentally disagree with that analysis.
The other risk, of course, next year is who ends up winning the presidential election itself. And I want to relate this to the interest burden discussion, because if Republicans come in, right, if it ends up being Trump or someone else, the natural response of the marketplace would be, okay, that means taxes will go down. That means the interest burden relative to incoming taxes will be, even more onerous.
Yeah.
Democrats, but Biden maintains or something else happens, Democrats stay in power. Okay, well, yes, sure. Then you keep on increasing taxes, but so the spending. So how do you think about sort of the party in terms of that interest burden tax dynamic? Because I think that's another complicating factor with this argument about the bond vigilantes.
Yeah, and this is a big debate inside the Federal Reserve. What's the term premium on the 10-year note? Is it being pushed up higher because of the interest burden that the U.S. government faces? And as a consequence, bond market investors, vigilantes, if you will, are demanding higher rates to compensate for that. Is it that growth is actually accelerating in the third quarter of this year? And so bond market is looking at accelerating growth, even though inflation is declining, and bidding up yields. It's a complicated question. From a political party perspective, I mean, first of all, we have to wait till January of 2025 for us to even begin having the conversation of what's going to happen from an executive and legislative perspective, because nothing's happening between now and then. There will be no higher taxes. There'll be no lower taxes. There will be no new programs that can pass. It's going to be a year of gridlock. And we have chaos in the House as it is, where the Republicans can't even pick a Speaker of the House. So that's problematic in and of itself, although to a certain extent, it also quiets down any other distractions that might be out there, like impeachment proceedings against President Biden, what have you. The net interest burden for the U.S., because rates have shot up so much, is now, is approximating the size of the defense budget, or certainly will in the relatively near future. Whereas when rates were so low, we were able to run very large deficits, and the debt service burden was lower than it was in the 1990s when deficits were considerably smaller. So it's a wall. What the parties do, I don't know. I mean, yes, would Trump try to cut taxes again, which the last time was just a sop to corporate America and very wealthy people, and it cost us ultimately, during the Trump years, the addition of $7.8 trillion in debt. I mean, Trump by himself, with with help from his friends in Congress, accounted for a quarter of the increase or I should say a quarter of the total size of the national debt. And then Joe Biden, of course, added to it. The difference here is I think that the spending in the Chips and Science Act and the Inflation Reduction Act is actually a net positive by improving and increasing manufacturing capacity in the U.S., finally dealing with infrastructure issues, modernizing the electrical grid, all those things, at least in my mind, and I could be wrong about this, and people will argue about it, enhance productivity of the U.S. economy and is ultimately disinflationary, particularly when you combine it with technological advancements in AI. So I personally look out towards the future and see more disinflation rather than inflation. Again, barring something that really, throws the world off course.
Yeah, and you and I share that view. I tend to be more a disinflation, deflationist longer term, just because of, like you alluded to, technology, demographics. Somehow the demographic argument turned from that disinflationary, deflationary to now inflationary, which is funny to me how the narrative just follows the moment of what's going on in asset markets. And then I'd argue also the wealth gap is disinflationary because Zuckerberg doesn't need 2 airplanes to get around. Right.
So whether or not he gives up 2 airplanes is another question altogether. Listen, Jeff Bezos, built his 3rd yacht, I guess, for $500 million with an image of his current fiancée carved into the front of it, the bow, I guess, like a Viking ship. And you do wonder, and not to quote Wall Street, because it's a movie that I find somewhat uneven, but how many boats can you ski behind? At a certain point, you wonder, with respect to ultra wealthy people who do pay far less in taxes than I think is appropriate. And you look at corporations, which now account for 7% of federal revenues. The burden of taxation has disproportionately fallen on individuals. That does need to be fixed. It's just not going to happen anytime soon. But yeah, everything added together that's going on in the economy, to me, looks more disinflationary, even as you say, even potentially deflationary than inflationary. Now, again, that's assuming that Paul Tudor Jones and Jamie Dimon, who both say, and I'm going to talk about this on CNBC later, that this is the most perilous time we've faced in our lives. May or may not be true. The Cuban Missile Crisis was pretty nasty and pretty dangerous. And yes, you have many malign actors operating at the same time now: Russia, China, North Korea, Iran, all to a certain extent backing Hamas, Hezbollah, and others, hoping for a regional conflict, hoping to scuttle the U.S.-Saudi-Israeli deal that was under discussion, that would have normalized relations between Saudi Arabia and Israel, would have allowed for the U.S. to provide a protective umbrella for Saudi Arabia, and also probably would have prompted Saudi Arabia to pump more oil in 2024. So clearly, there are many players who did not want to see that, and that does raise the stakes going into next year. It is potentially inflationary, assuming that scenario plays out in its worst form.
Just Louise said the remaining comments. Everybody, please make sure you follow Mr. Ron Insana here on X. If you want to come up and ask questions, click that bottom left mic request button. And as always, this will be podcast under Lead Lag Live on Apple, YouTube, and Spotify. Okay, now going back to years of experience and seeing all kinds of different cycles, you've also seen plenty of wars.
Yep.
Let's talk about how market reactions to war either are similar or different to other war periods. When the Israeli-Palestinian conflict really started getting the headlines, Sunday futures took a hit. Everyone said, this is it. This is the credit event. And I kept on saying, no, this is probably not going to be it because it's too obvious, right? And it's not really obvious anyway how war impacts stocks, at least in the kind of short to intermediate term. But any interesting parallels to how markets can behave going forward, you think, relative to other prior major conflicts?
They tend, rather bizarrely, except in the countries immediately affected, markets tend to look through geopolitical events, or at least certainly in our lifetime they have, right? The biggest impact on financial markets that I know in let's say in the 20th and 21st centuries is that the New York Stock Exchange closed for 6 months at the outbreak of World War I, which led to what was called trading on the curb in the development of the American Stock Exchange, because traders traded outside on the curb. That was a major disruption to market activity. Obviously, the outbreak of World War II, when it began, in earnest in 1939, was problematic, but you were also still stuck in the depths of the Great Depression, and you had policy mistakes made here at home. From 1941, post Pearl Harbor forward, the market actually continued higher. And so to a certain extent during the Korean War. Vietnam was different because Vietnam, when we started to escalate our involvement in 1966, that's when inflation started to accelerate. So from the Dow first hit 1,000 in 1966, didn't break through it until 1984 in a decisive manner for all the reasons we discussed before: inflation, stagflation, the huge run up in interest rates that we had in the late 70s and early 80s. And so you traded basically from 1966 to 1984 between 700 and 1,000. The Yom Kippur War had started at that point. Certainly it was the height of the Cold War between the US and the USSR. China wasn't really involved in the world at that point in time, except that they were, back in the Viet Cong along with Russia. So, generally speaking, though, just the outbreak of war, certainly go back to the Gulf War, the first Gulf War. We sold off going into the planning for the Gulf War. The market bottomed in October of 1990. And when it started on January 16th of 1991, the Dow actually rallied 105 points amid expectations it would be a very quick war, which it was over in 41 days. And then, 9/11 had an impact, obviously, but we were also in a bear market that was the result of the internet bubble bursting. And then subsequent to 9/11, we had corporate scandals that exacerbated. So we were in a bear market from 2000 to 2003, partly punctuated by the tragic events of 9/11. So, it's impossible to say that wars don't have an impact. By the same token, we are considerably higher today than we were then. And the effect, at least historically, has been temporary, not permanent.
So I'm reminded of a quote from Mark Twain: "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so."
Yes.
And I'm curious, because given your years of being in the media and talking to so many different thought leaders, the popular narrative, what popular narratives are out there that people just take for granted that you think are just ain't so?
One, I think that, that this is the 1970s all over again. I think that remains to be seen, or that inflation is about to take a second leg higher, which is something that the folks like Larry Summers and others have been pushing. And, I think it's the place where we don't know anything and where I can't make an intelligent statement is around the presidential election, which is going to be, an enormous variable. Whether or not we react or anticipate the outcome in the beginning of next year, I think, is an open question. To be perfectly blunt, I am terrified of another Trump administration, not because they would cut taxes and increase the deficit, because I think if you listen to his comments in the last several days, where he's been critical of Israel, where he's praised Hezbollah, where some of his commentary is wildly unhinged and wildly discontinuous from U.S. foreign policy, his presidency, along with the revenge tour that he'd be on here in the U.S., scares me. And as much as people complain about Joe Biden's age, they're only 3 years apart, by the way. Conversations that I've had with people in Washington, which is, by the way, another narrative that continues to make the rounds, that the president, our current president, is cognitively impaired. That is not what I hear from people who are close to him and who interact with him on a regular basis. And that seems to be a narrative that's pushed by, obviously people with a vested interest. And if you look at our response to the war in Ukraine, if you look at the rapid response we're having to what's going on between Israel and Hamas, the president is in charge of all that stuff. He's not just sitting somewhere, not making decisions. He's actually guiding that and leading that process. So that is a narrative that I think is entirely false. Just as I think that, comparing this period to the 70s is kind of a fool's errand. It would take a series of events to make that actually be an analog that's worth exploring.
By the way, I would extend that. I myself have pushed back quite a bit on this idea that we're in a stagflationary period. I don't think the system can work under stagflation when your starting debt is so high.
Correct.
You can't make the comparison to the 70s because of the leverage, economically.
Yeah, which by the way, ultimately, if you do have a credit event that involves the U.S. government, and I would argue that there are other more fragile economic systems out there that are more heavily indebted than the United States, China being one of them. But if you are in the camp that the U.S. government is going to have a debt crisis, that is wildly deflationary, unless the Fed monetizes the debt, the dollar crashes, and everyone stops buying U.S. treasuries. But again, that's also, it's a relative game, as you know, Michael. If there's a debt crisis in the world, and let's say it's China or Japan or Italy, people will buy U.S. treasuries before they buy anything else and actually drive down interest rates. If we're at the epicenter, something different would happen. But, that's not the first thing on my list of worries in terms of what prompts the Fed to move. It's up there. But again, I worry that China's going to implode economically, which may lead to some sort of military endeavor. I worry that commercial real estate, and I guess in New York, we have something like the equivalent of 9 Empire State Buildings of vacant space. And you see that in a variety of other cities as well. That's the type of thing that I think in the short run leads to a much more visible, much more palpable event that prompts the Fed to do something different.
Yeah, that's another narrative that also just kills me to your point. It's like, yes, people will go back and buy treasuries when there's a real shock and scare. There's this narrative that's been going out there for now several months that treasuries are no longer a hedge. And I keep going back to that's nonsense. They're forgetting what treasuries hedge against.
Yeah,
it's not that they hedge against stocks.
Yeah, right.
I put this whole post out in kind of like a Dr. Seuss kind of way, right? It's just like treasuries are not a hedge to stocks. They're a hedge to credit spreads. They're starting to blow out. That's what makes them a hedge to stocks.
Yeah.
It's the missing link in all of these narratives is ultimately about credit spreads, which have stayed abnormally tight in the context of this incredible speed of rate movement.
Yep. Yeah. And look, I mean, high yield has outperformed investment grade, which is also something very bizarre in this environment when we're starting to see bankruptcies accelerate. We're starting to see defaults on credit cards accelerate. We're seeing defaults on car loans accelerate. So the fact that we haven't seen the type of blowout where high yield, for instance, goes to 1,000 or 1,100 basis points over treasuries, still kind of locked in around 400, 500, which is almost a normal spread. You know, a lot of anomalies in the marketplace right now. Like the real hedge for me is in the 3-month bill. If you want to get 5.5%, you roll 3-month treasury bills for a while and you wait to see what happens. And that's your hedge. That's a higher yield than you'll get from the 10-year note. So if you're spending all your time worrying about what the 10-year note is doing and 6-month bills at 5.55, the 1-year bills at 5.41, you know, you got a built-in hedge at the short end of the curve. And people should have been shortening duration through this entire period anyway, because when the Fed's raising rates, generally speaking, until the curve inverts, you know, short-term treasuries are preferable to long-term treasuries. So they are still, depending on where you look on the yield curve, providing the ballast or the hedge that you would need in your equity, you know, in your overall portfolio, whether it's 60-40, 70-30, 80-20, however you want to, you know, put it together.
Yeah, I don't argue that the other hedge, of course, is paying off credit card debt.
Yeah, well, the average credit card debt for most Americans right now, the interest rate is 21%. So yes, if you want to save yourself a great deal of grief, because you cannot, unless you're paying down enormous sums on that outstanding debt, you will never pay it off at 21%.
Well, I'd also add, I mean, I can't prove this, but I also suspect that's why we're still in a bear market, because people still have the mindset of, you know what, I'd rather YOLO into cryptocurrencies or into the stock market and take a chance at a higher rate of return than pay off the guaranteed expense of my credit card bill, right?
Yeah, so, but that's, you know what, the funny thing is that's always been a problem, right? And the real problem resides in lower and middle income individuals and families who use credit cards as income extension, right? So they're willing to bear that interest burden and pay the minimum payment because they're managing cash flows. They're not thinking of gross debt and the overall exposures that they have. And so, you know, during periods of uncertainty, and we're kind of heading into one, and, you know, credit card debt now is over $1 trillion in the United States. It's a record. You know, we've seen people max out their cards at this point in time. And so, you know, I don't equate it necessarily back towards a bear market, but I do equate it towards rising levels of uncertainty, and also the middle class and lower income individuals in particular getting squeezed not only by inflation, but by a lack of support from the federal government, which was there during the pandemic and has since disappeared.
Separate from 3-month bills, are there other areas that look interesting to you from like an asset allocation perspective? I'm thinking more gold, the dollar itself, or is it just, the simplest answer is the right one?
I think the simplest answer is the right one. I mean, look, at some point, I happen to think that yields are peaking. I'm not in the 7% Jamie Dimon camp, but where, he said the U.S., in fact, the world is not prepared for 7% interest rates. Well, I think that's goes without saying.
It could be in 5 years, but not now.
Yeah, certainly not now. And look, the funny thing about the 10-year note yield right now is if you kind of strip out the zero interest rate experience that we've had since 2008, which is now a good 15 years. But if you strip that out, 10-year note yields are about normal, and so are Fed funds. The problem is we were levered to zero for so long, and the delta, the change and the speed of change was so abrupt that it's going to, as you say, it's going to cause a problem, just as other rate hike periods have caused problems. And so, can we handle a 7% 10-year note yield? Well, it's not the easiest thing in the world. Wouldn't be great for stocks. Certainly wouldn't be great for residential real estate. I just don't think we're going there. I think the Fed's going to continue to talk this tough game until it can't. And I think, again, like I say, that's probably 5 months out or so, maybe 6 months out. and then they're going to be forced to do something different. And, whether they want to or not. I think part of the process of the Fed taking rates up so far so fast was getting off zero, hopefully forever. They don't want to go back to zero. And if we have a recession next year of some kind, they'll take rates down to 3.5% or 4%, which is typical of a response to a recession. If something bigger happens, rates can come down even more. But unless there's a systemic financial crisis, which we had obviously in 2008, the pandemic itself was one, going back to zero and using unconventional monetary policy is something the Fed simply does not want to do ever again if it can avoid it. Ever is a long time. But I think that was part and parcel of why they did what they did in the manner in which they did it. And so they'll take the hit to commercial real estate. They'll take, a workout that is going to require lower rates and some sort of other type of intervention, whether it's at merger and acquisition activity, suspending mark to market, whatever kind of tricks you've got to pull, which is, lend, extend, and pretend, whatever you have to do to get through the period. I just don't think they want to repeat what transpired, over the course of the last 15 years, which is why they did what they did and the way they did it.
But presumably they're still going to have the optionality around the balance sheet expansion.
Yeah, and I think that's another thing that's got to go away is QT. I think quantitative tightening is a real mistake here in the sense, and you've heard this from the National Association of Home Builders, the fact that the Fed is letting its mortgage bond holdings roll off without reacquiring them and maintaining the size of their holdings is pushing up mortgage rates now above 8%. And again, when you're locked in at much lower rates on existing single home sales, you're constraining supply and actually exacerbating housing inflation rather than curing it. And then there's the additional factor that private equity owns about 16% of the existing housing stock right now as rentals, and that's not going onto the market as supply. So you've got this rather unusual experience. While home builders are building out new homes, existing single family home sales are stuck. And in fact, they're down about 30% year over year. And I've argued in print and on CNBC that the Fed is actually the cause of housing inflation, not curing it with higher interest rates.
Yeah, I think that's spot on. Again, anybody wants to come up with next question, click that bottom left mic request button. I was looking through your timeline, Ron. I saw, I think maybe like a month ago, you said Goldilocks is back. And I don't know if you were being sarcastic.
It was 3 months ago. And
3 months ago, yeah.
I was not being sarcastic at all. I mean, in the sense that, when you look at job creation, which has been, continues to be robust, when you look at GDP growth, which is above consensus, when you look at inflation coming down more than the Fed certainly had anticipated, it's not a horrible scenario. There are, like I say, there are going to be problems down the road, but relative to the rest of the world, the U.S. is still the strongest economy with the least inflation, and to a certain extent, with the smallest problems. I mean, you look at Europe, and Germany's in tough shape, France is in tough shape, the UK is a basket case. Italy has a debt to GDP ratio that far exceeds ours. All of Europe has a bigger demographic problem than we do. China, in my mind, is an economic disaster and looks to me a lot like Japan in the late 80s, early 90s as it was imploding. And Japan may be rebounding and their market may be doing well, but it's a liquidating trust. They have more centenarians than they have births. They have more deaths than they have births. They're going into irreversible population decline, something that China is about to experience as well. It's now smaller than India from a population perspective. And it's estimated, not that we'll be around to see this, but by 2100, China will have 800 million people, down from 1.4 billion. So we have issues for sure. And if you want to call us the cleanest, shirt in a pile of dirty laundry, or the best house in a bad neighborhood, I think all that's true. And again, Goldilocks for now until, some of these other issues materialize, which again, I don't think are going to take place until sometime next year.
Yeah. And it wasn't me knocking the idea. I think when people hear Goldilocks, they confuse it with a way of characterizing the economy as opposed to a way of thinking about the stock market. Because the two, again, are not necessarily the same. You can have a Goldilocks economy and a very overvalued market that still corrects.
Oh, yeah.
Down to be.
Listen, everybody's, wetting the bed a little bit over the fact that we've had like a 7% correction in stocks. Some of the bigger names have come down more, obviously. And there are stocks that are still in, definitive bear market trends. Like you said, small cap stocks have done nothing and they've fallen 12% from their peak earlier this year. Even the stock market's not uniform this year, So, yeah, I tend not to conflate the two. I still believe, however, that markets lead the economy by a certain amount of time. And so, which is why with the yield curve having been inverted now for 18 months, even though it's flattened out recently, we're still in the window in which a yield curve inversion precedes a recession by anywhere from 6 to 15 months, 12 months is average. And we went into inversion in November of last year. So there's still a window where, we could slide into recession, and the yield curve indicator would still be an accurate, usable one. But yeah, I don't tend to separate the economy and the markets in maybe in the manner that you do. I view them as leading indicators, and in fact, more accurate leading indicators than the compilation of leading economic indicators that the economists use. Because I do think markets are discounting mechanisms, not, they're certainly reactive to some events, but I think in the long sweep of things, when you look at how commodities, interest rates, and stocks behave, they tell you a lot about the future shape of economic activity.
Yeah, and by the way, I don't disagree on that at all. I think I would push back on which markets. I mean, to the extent that large caps are being driven by the auto bid of 401ks going in there every single, a portion of income going in every single month. That creates a distortion in the pricing discounting mechanism. So maybe small caps or mid caps, which are less sensitive to that dynamic, might be more accurate. But that's just sort of nuance. I do have to ask you though. I've been having fun. I mean, I often joke a lot, obviously on X, but I've been having fun.
Noticed.
Which apparently few understand for whatever it's worth. It's like it's a persona. To me, it's funny, but anyway, the one of these things now, these narratives that's out there is everything seems to be because of Ozempic.
Yeah, right. Yeah.
Oh, right. So markets are going up because of Ozempic. Markets are going down because of it. Okay, so more of a side note, but are you watching this at all? This supposed mass weight loss that Ozempic's causing?
Well, I am, because I had a family member who was using it and had an adverse reaction to it, and I'm not sure just how long it will have an impact on behavior. Because I was reading a Wired magazine article where the scientists who were involved in the early development of these GLP-1 drugs, the types of things like Wegovy and Ozempic that are currently, in fashion. And they argue that the average patient stayed on it for 2 years because the joy of eating was so diminished over time. And this has also been true because I noticed from one family member who was on it, who was, throwing up after eating, certain types of food and having difficulty, staying comfortable and also just having zero appetite. That, yes, I understand the mechanism on how it works in the brain and the appetite function. The scientists themselves who are there early on don't think that people will stay on it for the rest of their lives. And judging from some of the reactions I've seen from people who are using it and who have, and again, this is both a curse and a blessing, you lose the joy of eating, and it does alter that behavior rather significantly. And they said the average length of time that someone stays on it is about 2 years. So yes, is it a semi-miracle drug to the extent that it affects people's appetite? Sure. Is it something that's going to be, in use forever? It depends. It would have to be, I think, modified in such a way that people can live a normal life without overeating, without necessarily, doing things that are damaging to them from a cardiovascular perspective with respect to diabetes or other issues. But can you live on, basically kind of what ends up being almost a bread and water diet with no joy associated with that social experience? I think that's a big question. So I think it's probably an overreaction to what the impact is, at least, well, certainly in the long run. I think there would have to be some real modifications to the drug. And again, I'm speaking as a layperson, but someone who's witnessed the side effects. And I'm not sure it's going to last as long as people think.
Yeah, it's just Samantha LaDuke was the first one who brought up that idea. That's the new AI narrative, right? Like everything that relates to the market is because of now, Ozempic, semaglutide, or Wegovy. And it's not the American way, by the way, to not want to eat.
No, it's not. But it's not any culture's way not to want to eat. I mean, I'm a Sicilian American kid who grew up with, a certain set of behaviors. God bless my parents for, encouraging some really bad things over the course of my life. But look, eating is as much social, culturally as it is nutritional. So, yes, the U.S. in particular has a real problem with the type of food we consume relative to a lot of other cultures, and that is an issue. And do I believe McDonald's is going to go away because of Ozempic? No, I don't think so at all.
But I do think it's funny that it's becoming almost like a scapegoat. I mean, I put out a post seeing, I think it's the Walmart CEO said, well, we're seeing Ozempic is impacting grocery sales. It's like, no, it's because the price of food is so fucking expensive.
Yeah,
right?
There's that too. Yeah, I mean, And yeah, look, and I think that's going to right itself over time. I mean, like we've had some really weird disturbances in food prices, like, price of eggs went up on bird flu, for a period of time, and transportation costs and things like that. So goods prices are actually falling. And I think that will effectively, at some juncture, push food prices back down. I don't think they're permanently inflated. Now, there is a question that the overall price level has gone up in a post-pandemic world by 20%. Can we get prices back down to where they were pre-pandemic? That's an open question. Can we slow the rate of inflation so that it's much more acceptable? I think that's certainly within the realm of possibility.
Yeah, I mean, I'd argue you can get the prices back to pre-pandemic levels with a massive credit event shock, right? I mean, that's one way. Well, the other one, of course, is just, more competition, which, that's the least likely scenario anyway, right? I mean, that's the perversity of all this is that the Fed hiked rates is basically killing off the idea that anybody can come in and even compete against the oligarchs of all these different industries, of the oligopoly type of dynamics. And that makes it even harder for prices to come down. The stickiness is because there are not that many true competitors.
Oh, you're starting to see that, though, with some Chinese companies that are coming in with, product offerings that are competing with Amazon. Whether or not they'll be allowed, permanently into our market is an open question. But you are seeing like there's some, I don't know how to pronounce it, as SHEIN, a big, online retailer that I believe is, originated in China, is just sending out mass emails. I get like 7 or 8 or 9 or 10 a day on, sales of specific types of goods. And you're seeing them come after Amazon. And, they may be dominant now, but, Amazon displaced Walmart. So the question is now, who displaces Amazon?
Well, no one will ever displace Ron Insana. So everybody, please make sure you follow.
I'm getting close to my sell-by date, so we'll have to see about that.
Where do people track some of your thoughts and work, Ron?
Still on X, certainly on CNBC.com. Generally speaking, I'm on CNBC every Friday on Power Lunch with Tyler Matheson, Kelly Evans. And then available for speaking engagements, at your convenience.
Everybody, again, please support Ron. Follow me here. Again, this will be a podcast soon enough, and appreciate everybody that joined. Thank you, Ron. Appreciate it.
Hey, thanks, Mike. Good to talk to you.